Hey, this is Sasha. Thanks for joining me in today's video. And what I want to do is share with you some insight on how to basically get a $0 vertical spread and pay nothing. So if you're looking to buy some call vertical spreads, how do you do it for $0? So that's what we're going to cover kind of in this video. I'm going to give you a short little tidbit on it, and then I'll kind of go from there. Maybe it'll get your brain thinking a little bit more. So stay tuned. All right, so not everything is free. There's not a lot of free things out there. So just you watching this video, you think it's free, but you might be seeing YouTube ads somewhere along the lines. In either case, I'm going to give you some insight on this. And when you go in and buy a $0 vertical spread, it's not necessarily free. There are some risks still associated with it. So what we're going to do is we're going to go ahead and pair it up with another strategy, and then basically pay off our vertical spread in a sense. So let me show you how this works and the construction behind it, and then maybe it'll give you some thoughts and tidbits. Okay, let's go to the screen here. This is the Thinkorswim panel and platform. This is American Airlines, so AAL. It's tanking pretty heavy, and you might say, man, this stock is amazing. I will love this stock, and I love flying American Airlines. Maybe, maybe not. But in any case, if you want to take a cheap shot on this or any other airline right now that's down, like UAL, for example, then you could do that. But I'm going to go ahead on AAL just because of the construction that I just worked earlier and show you this concept. So let's say you want to go ahead and believe in the next, 60, 80, 90 days, 40 days, somewhere along those lines, it's going to go ahead and go higher. That's what you're thinking. You're thinking, hey, man, it's going down. I want to get into this stock. So what can you do? You can say, okay, I'm going to go 44 days out. I'm going to say, I'm going to get the 13 and a half. I'm going to buy a vertical, and we're going to go with an out of the money vertical spread. So here we go. We go with 13 and a half and a 14 and a half, and it's going to cost us about 33 cents. So that means 33 bucks. It's like, oh man, I'm going to lose 33 bucks. Okay, cheap stock. So if we go ahead and pop higher, you'll make, you could make 67. Probably you won't. You might make only 30 bucks or so. But the problem is, well, if it stands here, hangs out here, you lose 33 bucks. That's not good. So what do we do? Well, what we can do is actually go to this little thing over here to maybe about 11 and a half or even a 12 and sell a 30 put against it. So you can see it's not necessarily free on the thing that I'm doing. It still costs you some money because if it goes against you, you do have to take that stock at 11.50. But now if it flatlines, okay, and continues to go down to about that 11.50 level, the most you'll lose is about 3 bucks. That's it. Now I had this set up earlier when I was doing the simulation or a hypothetical situation before I filmed the video. It was around $0. But here, what you could see is it's basically you'll lose 4 bucks. So even if it goes down, 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 at the moment you'd be losing like $30. But towards the end, if it stabilizes, the most you'd lose is 4 bucks. So it's kind of like getting a free vertical spread when you think about it, because what I'm doing is I'm buying something for $34 and I'm selling something for $30 against it. It's going to cost me 4 bucks. That's how you set something like this up. And of course you could multiply it. Like let's say it's 20 contracts here. You could do 20 contracts here. And you could even do 21, a little extra there, or even a little extra 22. And now as you do this, as you're starting to trade larger, okay, look, I'm selling 23 contracts against the 20 that I've got. Okay. Basically what I've got here is selling some puts and I'm making 10 bucks at most here, as long as it doesn't go too far down below that 11.50 mark. So that's what I'm doing here. And you can see the construction of it. It's very nice and situated quite well there as you go through and set up the construction. And it's just by happenstance the way that this spread works out. And that's nice to do on stocks that are super cheap already. Catch a falling knife kind of thing. Maybe, maybe not. I wouldn't do that with too much of a catching a falling knife. But it is one that maybe you could think about of, hey, you know what, I believe in the stock, but maybe I don't believe in it that much, so I don't want to risk everything. You could also take the approach of where you sell just less of these. Actually, if you're doing like 20 contracts, you could just sell like 15. And that way you don't have as much risk or exposure. Because remember, when you're selling puts, you got to be able to take the stock. If you can't take the stock or you can't take the heat, that's going to be a problem. So you don't have to sell to get this back to zero. You could just sell it so you're only losing 210 in that zone rather than maybe 660. So would you rather lose 210 or 660? So when you're doing something like this, you could just compensate by limiting your losses. Anyways, I hope that helps. Gives you a little bit of a new way to think about some things and maybe some things to check out, and maybe it's helpful. Definitely check out our website if you want to learn more, or join me on a one-on-one session on the Traders Fly website. And that way you can go ahead and discuss some of your own personal needs, problems, situations, strategies, technical analysis, and much more. All right, thanks for joining me, and I will see you in the next video.